Hi all. Today we are going to discuss about variances. Especially, we are focusing on material variances. So, discussing about the variances as part, it's a big part of our PM syllabus. Okay, there will be basic variances which you would have already been studied on MA level, but we'll be just revising those particular concepts and going into more advanced variances, especially your material mix and yield variances and other like planning and operational variances as well. So here today what we'll be focusing on will be only on material variances. So let's consider what all variances we'll be studying over here. So like material price variance, or especially this is relating to raw material only. So your material variances, we are studying like the basic variances. One would be your material price variance, right? So you have a material price variance. Then what would be the other you will be having? The second one is your material usage variance. So let's discuss a little bit about these two things. What is a material price variance and what is a material usage variance over here? So material price variance, or in short, we will call it as raw material or what we need for producing a particular good. So material price variance is that out of the total cost variance we have for the material. Take an example. Let's say you require material X for producing a product A, and the total cost of that particular material, okay, what you have budgeted and what it actually came will have a difference. Normal cases, so assume it was like $10,000 budgeted, but it was came as like $11,000 actual cost. This $11,000 actual cost and $10,000 budgeted have a difference or a variance of $1,000, and this $1,000 could be due to one, it could be due to the budgeted purchase price you would have expected would be, let's say, assuming it would be 4.5, but actually it costs 5. So it could be coming from the price point of view. So there is a budgeted, when you go for a budget, you budgeted at 4.5, but it came as like 5. So this result in a variance, it is purely relating to what? It's purely relating to your price. There is a change in what you expected and what actually came as a price of that particular material. Now coming towards the second reason for the variance could be, let's assume for producing this particular 1 unit of A, you have expected that I'd be using 5 kg of this particular material. But what happened in reality, instead of having 5, I have to consume or I have to put in 6 kg. So this could be the case. Okay. So expected usage, or I was expecting to only use 5 kg over here, but we used how much? We used 6 kg. Okay. This variant, and again, like the cost for having this 5 kg and cost for buying this 6 kg will be different. So the cost variances of this material, raw material price, would be the one reason, or it could be the actual usage versus the budgeted usage, which would be causing the reason. So these are the two basic variances you would have already studied in MA level. But again, let's revise this particular concept. Okay, so let's note it down. So price variance is due to the change in budgeted price versus what the actual price is. Okay, and material usage variances is like what happened. It's a budgeted usage of the material versus actual usage which came in producing that particular thing. Okay, so if I have to note down this particular things into a particular formula, okay, it is very simple. Okay, let's consider, okay, what is common in this particular column over here? Okay, it is a budgeted price and actual price. Okay, now we have to quantify this particular thing, right? There's a price is given, so we are looking at what is your actual price, what is your budgeted price. We have to quantify this. thing, right, on the actual quantity. So we'll be going for something called, if you're following some approach over here, something called AQAP versus I am going for AQSP. Okay, nothing but if you're going for a explanation point of view over here, it is like what is the actual quantity at your actual price. Okay, so actual quantity at actual price. In short, we are looking at AQAP, meaning what is your actual cost. What is your actual cost? That is your this thing. This is your actual cost basically. Okay, what actually came? So this would be normally given your exam questions here. Now coming to AQSP. Okay, it is again, as you can see, it's actual quantity again, but actual quantity at now at your standard price. Okay, you would be budgeting on a, if you are going for a single space, it would be going for a standard cost. No, so standard price. So what is the standard price? It's a unit cost basically. Okay, standard price. So I would say what is the difference between AQAP and AQSP will give you your material price variance. So this is your price variance formula. Okay. Now what about my material usage variance? Okay. Now common thing, what is the different thing we are looking at? Budgeted users versus actual usage. Okay, budgeted usage versus actual usage. So you will be taking AQSP versus will be going for standard quantities. So we have to quantify this thing, not quantify, we have to monetize this particular thing. So we'll be using a standard price over here. So this will be SQSP, standard quantity at standard price. So whatever is the difference between your standard quantity at your standard price. Okay, so standard quantity at standard price will give you what is your material usage variance. So this is the formula you will be looking at. So let's consider SQSP now. The thing to look at here, what is the standard quantity here? Now consider a little bit example. We'll go for further example, but let's consider an example. Okay, if what is the difference between an actual quantity and standard quantity and a budgeted quantity? So we have to look at these things very carefully. What is actual quantity? What is your budgeted quantity? And what is your standard quantity? These three things are different. Okay, actual quantity is what actually used or what actually used or came. That is your actual quantity. Budgeted quantity is what originally you have budgeted. What originally you have budgeted, that is your budgeted quantity. Now what is your standard quantity? It is quantity for or quantity required for. Quantity required for the actual production. Quantity required for the actual production at standard usage level. We'll see what this is actually. Okay, in the next question. Now let's consider a revision of this particular concept using one example over here. Now let's consider this example over here. Okay, so James Marshall Company makes a single product with the following budgeted material cost per unit: 2 kg of material A at $10 per kg. Okay, let's note down our particular columns over here so that we get our values clear. Okay, so one is like we need to get the price variance, right? So raw material price variance we need to get. So that let's go for the price variance. Okay, now second one is your usage variance. Simple. Okay, so usage variance. Now we have to note down the particular things we have noted down in the earlier sheet as well. So one is like AQAP, and we have differences AQSP and SQSP. So we have these particular columns over here as well. So we have to calculate this particular value. So it's very easy. Let's read to the question. Okay. So James Marshall Company makes a single product with the following budgeted material cost per unit. So this is a budgeted cost, material cost per unit. Per unit meaning it's a standard cost for one unit. So if you are producing only one unit, you would be using 2 kg of material A at a standard price of $10 per kg. So you got the standard usage of one unit, 2 kg and 10 kg over here. Now, what is the difference between this budgeted? So let's say I have originally budgeted for like 500 units. If I have originally budgeted for 500 units, my budget kg was 500 into 2000 kg was my budgeted quantity. You got the point, like assuming it's not in the question, but let's say if I have originally budgeted for 500 units of output, let's say actually is 1000, but 500 is your budgeted original budget. On the standard users, like for the budget 500 into 2, I would be having 1000 kg as my usage, and 1000 kg into 10,000 would be my cost over there. Okay, so that is what we will be looking in here. But consider our output 1000 units. So your actual quantity came, or actual quantity you being used as 2200 kg, but against what? 1000 units, 2200 kg. Now what is the standard quantity being used? If I am producing 1000 unit is like, for one unit it is 2 kg. So 1000 unit, it would have been 1000 into 2, 2000 kg only instead of 2200 kg. So this is a difference. Like what is the standard quantity? Standard usage multiplied by the original or actual output. That is your standard quantity. Now let's consider filling this particular information into columns over here. Okay. Now, I think the question is pretty visible to you. So I'll just move this particular thing to the left side a little bit. Okay. So let's consider this particular example. So first thing is AQAP, actual quantity at actual price. As mentioned earlier, this AQAP is something that is your actual cost. So it's very straightforward. Okay. So we can get in the question, as you can see, the actual output is 1000 units, material purchase is 2200 kg, and material cost is $2,900. So you have an AQAP priced at 2,900. Okay, so this is your cost over here, 2,900. That is your actual cost. So actual quantity at actual price is your actual cost, which came as your material cost of 2,900. Now the question is like, what is your actual quantity at the standard price? Now let's consider. Okay, see the formula over here, equal to what is your actual quantity? Material purchased and used is 2200 kg. So 2200 multiplied by 2200 multiplied by how much you should have? 2200 multiplied by what is your standard price? 10 per kg. So into 10, this would have been your AQSP. Okay, so actual quantity multiplied by the standard price of 10. So this is one thing over here. Second thing is relating to SQSP. Now what is SQSP? Standard quantity. Now let's consider what is your actual output. 1000 units. 1000 units multiplied by what is your standard usage per unit. You are expecting like 2 kg would be used, 1000 into 2. So standard quantity is 1000 into 2. Now SQSP, standard quantity multiplied by standard price. What is standard price? 10. So you will get 20,000 as a figure over here. Now let's compare this particular thing. Now what is your price variance over here? Price variance is like AQAP and AQSP. Let's take the difference over here. What is your AQAP? 2,900 minus 22,000. You got 1,100 difference. Now don't look at the negative or positive sign over here. What you need to consider is like, normally like when we are following this particular order, it would be like you'll be minusing the top from the bottom, and if you are getting a negative over there, it would be an adverse variance normally. But the concept is like, let's, we are comparing what in a price variance, we are comparing an AP versus what, your SP. So actual price and standard price. So meaning like you have budgeted something which came as more than that, meaning it's a cost. Since it is a cost, higher cost meanings not favorable to us. So you will be having an adverse variance. So 1,100, you will be having an adverse variance over here. It's a negative one. So you will have, I'll note down it as a red one. So it's an adverse variance over here. Okay. A meaning adverse. It's an adverse variance. Now coming towards the other one, okay, 22,000 versus 20,000. Now what you have to consider over it is the usage. So we have to consider whether the standard usage was higher or the actual usage was higher. So herein, if the actual usage is much higher, again you will be having a negative variance. So 22,000 minus 20,000, again you are getting what? If you're going this order, it would be positive, but again this is a negative variance, so it would be normally a negative variance because you have used how much? Standard quantity is, standard quantity to use was 2,000, like 1,000 into 2, but you use more than that, meaning like you are going to go for more in this case. So actual was much more, so we'll have an adverse variance over there. Or is it the case? Okay, so you will have an adverse variance over here. So for the price variance, now what happened here? Price variance, it is like actual cost is much lower. Okay, so let's consider again. Okay, little bit correction over here. So we have a 2,900 actual cost, so it is not an adverse variance. So we'll be going for this particular thing over here. So meaning like we are looking at what is your actual cost. Actual cost is less than your standard. So you will have a difference of 22,000 minus 2,900. If it is getting positive, this is favorable. Okay, noting down F as favorable. Okay, and this one is again like you are going for the same formula. If you are going for here in like 20,000, what was being budgeted versus this particular thing, if it is getting negative, then it going to be an adverse variance over here. Again, what the concept we will be using is here is that first thing is like, consider what is the cost. The other one is SP and AP. So if you are looking at an individual thing, what is your actual price and standard price? If the actual price or actual cost is more, it would be adverse. If it is less, it is favorable to us because this is a cost. Okay, now coming to the usage, it would be you are looking at how much. Okay, I was using only like 5 kg. I was expecting to use 5 kg, but if you use more than that, it becomes an adverse. So in this particular case, for 1,000 units, you're looking at 20,000 kg only to be used if it is on a standard usage basis, but you actually use 22,000 totally. So that is the difference over here, which is giving you an adverse variance. So whatever variance you are calculating, you have to focus on that particular variance to see whether it is a favorable or adverse. Again, favorable meaning what? Favorable meaning, okay, which is beneficial to the company, which is giving an advantage to the company. It would be like normally if the cost is going below or cost is going down, it would be better for the company over here. Okay, I believe that serves the basic variance cases here. Okay, let's consider another example with your mix variance in total. Okay, mix and yield variance. Okay, this was a basic thing. Now let's go and see what is with the mix and the other variance. Okay, so for this one, okay, usage variance, your material usage variance. Again, would be relating to something if you are having more than one raw material being used, this only comes in that particular case only. So if you are using more than one raw material, what would happen? Okay, so let's consider a product using A and B, and this usage variance. Usage variance is what? The difference between what was the expected quantity be used, that is your standard quantity, and the actual quantity being used for the production. Now, this usage could be due to two things. One is like what you have input, so what mix you are using. Okay, meaning I am using two products, I may be using, I was expecting to use it on a ratio of 1:1, but actually I needed 1:2. That was the mix I am using. So due to the difference in the usage or difference in the input, that could be one thing. And the other one is like whatever input you are putting, that input giving you some yield over there. So what is the yield? If I am putting 1 unit, I am expecting that from this one, this much would come. So that particular thing. So it could be due to these two things. One is relating to the mix you are putting in, or the one is whatever raw material you are using, how much output it can produce. The capacity they can produce, the capacity they can yield. That's why we are having a mix and yield variance over here. So I'm just noting down as mix variance. We have a mix variance and we have a yield variance, which is a subclassification of, what? Subclassification of material usage variance. And to be noted, only appears when, as I explained before, only appears when there is more than one material used for producing a product. Okay, so this is what you have to see. So only appears when there is more than one material used for producing a product. So for this also, like, we will be using some formula because it's easier that way. So but you have to learn the concept also over here. Okay, so let's consider for mix variance what you have to do. Okay, let's consider an example, or let's consider an example over here. Okay, so this is a question you have, and I think it's visible over here. So we are going for the mix variance first. Okay, so how you'll be calculating the mix variance, that is the first thing we have to see. So mix variance, in order to calculate the mix variance, you need to consider two things over here. One is actual quantity, actual mix. This is purely relating to the quantity wise. So let's put it down into bigger columns so that you also understand what it is actually. So let's consider wrapping this. Fine. So this is actual quantity, actual mix. Okay, AQAM is your thing. So actual quantity, actual mix. So you have to take the difference of the other one, so which is actual quantity actual quantity at your standard mix, or in short you can call it AQSM. Okay, now let's consider, okay, there is another column which will be going for the difference. Okay, so in short we are going for a difference, but when you are taking a difference you have to go, if I'm numbering over here A and B. Okay, so difference could be, difference you have to calculate always with B minus A in here. B minus A should be your calculation over here, and then you have to multiply it with your standard price for that particular material. Okay, then it will give you the variance, what you are looking at. Okay, so this is what you have to do over here. Now, what does AQM and AQSM? For this one, you have to see, okay, how many materials you will be having. So in the question, let's see the question and fill it in over here. So Hondru operates a standard costing system. Okay, so the standard direct materials to produce 1,000 units of the output is as follows. So for producing 1,000 units, the below quantity is required. So 1,000 units you require 600 kgs of A, 240 kgs of B, and 360 kgs of C. And on the right side, they have given you the kg price of A, B, and C as 1.10, 2.40, and 1.50 respectively. So these things we can look and understand. Okay, so you got your standard price over there. So I can just note it down over here. So I have three products, A, B, and C. Not three products, three raw materials, A, B, and C. And for this A, B, and C, I got the standard price directly. What is your standard price? 1.10. Okay, 1.1, 2.40, 2.4, and $1.50. So these are the price you are having a standard price of 1.1, 2.4, and 1.5 over here. Okay, now let's consider what is your actual quantity, actual mix. It is your actual quantity which came as, or actual quantity what you have been using it. So as you can see over here, during the April, actual output of the product, actual output was how much? 21,000 units. For the 21,000 units, actual material issued to production or actual material consumed by the production were A, 14,000 kg. So that is your actual quantity which came in the actual mix. That is your 14,000, okay, 5,500, and I also have 5,500. Now let us consider for producing 21,000 units. For producing 21,000 units, I have consumed a total material including A, B, and C of 25,000 over here. I hope till now it is clear for you guys. Now again, like 14,000, 5,500, and 25,000 over here. Now what you have to do for looking at, so you actually use the total material with a quantity of 25,000. So your total of the next column should be 25,000. So actual quantity is the same, right? So actual quantity, total actual quantity should be the same, 25,000. Now what I need to consider is that out of the 25,000 actual quantity, what would have been the quantities for A, B, and C on the standard usage? So if you are considering over here, let's consider what is the standard usage. 600 is the, 240 is the, 360 is there. So if I'm adding down 600 plus 240, I am getting 840. 840 plus 300, how much? 11,040 plus 60, you're having 1,200, right? So basically, so let's do a calculation also over here. So your standard usage is how much you are using per 1,000 kg? 600 plus 240 plus 360. So you have a total standard usage. So sorry with that formula error, but you have a standard usage of 1,200 over here, right? So 1,200 in total. So if I'm going in that particular ratio, what would be my usage over here? So out of the 25,000 multiplied by the standard usage ratio. Okay, out of, for example, 600 was the standard usage for A out of the standard total usage of 1,200. I'm using that proportion so that in the standard mix, what would be my actual quantity? So I'm getting 12,500 for A. Same way I'm going to calculate for B. 25,000 multiplied by, okay, what was the proportion? 240 divided by the total standard usage of 1,200. Okay, 5,000. Same way again, you're multiplying your 25,000 along with the standard usage of 360 out of 1,200. Okay, over here. So you got the standard usage, or let's say actual quantity at the standard mix. If it was mixed using the standard proportions, what would be your actual quantity being distributed. So we'll have it over here. So what you need to do the next is like taking the difference over here. Very careful. You need to take like column B minus column A over here. Let's consider 1500. So I'm just copy pasting the formula. Okay, or let's say let's do it one by one. So we are going for B minus A. Okay, again you are going for B minus A. Now if you add all these put thing together, it would be 0. So meaning there is no variance. No, actually this is only the quantity wise. So actually out of this 14,000, or the proportion of A, B and C changed in actual mix and standard actual quantity at standard mix. That's why this variance is coming. Now you have to value or monetize this using the standard price. So what you have to do is you have to multiply this particular thing with the difference with your standard price, whatever the sign you are getting. If it is negative, this is adverse. Okay, so same formula again. Okay, 500 multiplied by 2.4, negative 2200. Again you are getting an adverse value here. Same way you are going to do 2000, which is a positive figure, multiplied by 1.5. You're getting positive. Actually there's a error in formula, so you're getting a positive. So this is a favorable variance. So in short, okay, what is the total variance you will be having? You have to total it again. Okay, so total it. So you have 150 positive, meaning you have a 150 favorable variance here. So this is your 150 favorable usage mix variance. So material mix variance is one part of a usage variance. So you are calculating a mix variance. So what you need to follow, you need to follow this particular approach of the table, which will be having AQAM, AQSM difference, standard price multiplied by the difference, you will get the variance. So total. So if I am looking at the total mix variance, it is 150 favorable for the this particular problem. Now let's consider the other one, which is your yield variance. Okay, so what is your yield variance here? I'll be borrowing one column from the above because I have to take the same thing only. So yield variance, I am taking this second column from here. Okay, and this control C and control V, then it will not give me my this thing. But again, like I'll be putting what I'll be going for the alt TSV, so that values will be there. So I'm just taking the figure from the above. Okay, so ABC, you're getting 25,000. What is this? AQSM, actual quantity standard mix. Now I need to compare with what? Standard quantity with standard mix. Okay, standard quantity, standard mix. So standard quantity, standard mix. Okay, in short, I am going for what? Standard quantity, standard SQSM. Now SQSM, again, you have to focus what is. I am not going for 25,000 here. What you have to see is that what is your actual output over there? What is your actual output? 21,000 units. For this 21,000 units of actual output at the standard usage, this is 21,000, right? So standard usage is like for 1,000 units 600. Okay, so I cannot directly go and multiply this with what? 600. So I have to do, okay, how many thousands units block is there? So 21,000 divided by 1,000 will give me that how many blocks I am having over there. So it is basically like 21 I'll be having. So this into this multiplied by, why I'm dividing 21,000 by 1,000? Because the input quantity or standard usage is given in 1,000 units. Okay, so for that I'm just going to divide it by 21,000 into 1,000 into, okay, for every 1,000 units I would be using 600 kgs of A. So this is my standard uses of 12,600. I hope the way it is being clear. Okay, now what is the other one? Let's see the next one, same way around. Okay, again for the 21,000 divided by 1,000. Why divided by 1,000? Because I need to see how many thousands is there. as explained in the previous line, multiplied by, for 1000 units I would be using 240. Okay, same case over here. Okay, 21,000 divided by 1000, okay, multiplied by 360, which is given in over here. No, 360, it is given over here. So that 360 multiplied, so you will get 7560. Let's total it. This is your SQSM total. So 25,200. Now all the other columns over here will be coming the same way only. Okay, so I'll be going for different standard price variance. So this is again B minus A. What is B minus A? You have to multiply, you have to go for 12,600 minus 12,500. Again 5040 minus 5,000. Again 7560 minus 7,500. Okay, now standard price is already the same above. Let's copy paste. Okay, variance is basically 100 multiplied by 1.1. Okay, positive one, so I'll be going for favorable variance. Okay, again 40 multiplied by positive, again 2.4. Okay, again I'll be going for a favorable variance because it's positive. Same again 60 multiplied by 1.5, getting me a positive figure. So again I'm getting a favorable variance, and we have a total yield variance of how much? Okay, how much I'm getting over here? 296 favorable. So this is your usage yield variance. So this is how we will be doing this particular question. Now let's add these two things together so that if it is like a usage variance, the total of these two things would be a usage variance. So I'm adding 150 favorable plus, okay, 296 favorable. I'm getting 446 favorable as my usage variance. Okay, now let's cross check. What was the formula for my usage variance? I was going for AQSP versus SQSP, right? So actual quantity is standard price and standard quantity is standard price. This was my formula. So if I am going to do it for all the particular things over here for A, B, and C, if I am doing this, I'll get a usage variance, right? So basically, let's take it on a column wise here, cross-checking purpose only. Okay, so for A, B, and C, okay, so actual quantity, standard price, actual quantity, standard price, how much? Actual quantity was 14,200, right? You can get from this particular question. So equal 14,000, okay, multiplied by what is your standard price? 1.1. Okay, again B 5,500 multiplied by 2.4. Sorry, 2.4, 13,200. Again 5,500 multiplied by how much? 5,500 multiplied by 1.5. So we have 8250 as the AQSP over here. Now SQSP, what is the standard quantity? Standard quantity we have calculated. Standard quantity at standard mix we have calculated over here. It would be 12,600, 5040 and 7560. Okay, standard quantity we have calculated over here. This needs to be multiplied with what? Standard quantity need to be multiplied with the standard price of 1.1. Okay, needs to be multiplied with the standard price of 2.4, needs to be multiplied with the standard price of 1.5. Sorry, 1.5. So this is your SQSP. Now let's take the difference variance. You have to see. Okay, what you have to do? You have to see the difference between standard quantity and this thing, right? Okay, so what is the difference we are getting? From which we have to minus? From the standard quantity or actual? You have to minus from SQSP minus this thing. So 1540. What do you have to get over here? You get a 446 positive over here, right, in total. So this is like in between, sorry with that. So let's consider the example. So in between, if you are saying for the usage variance of A is being like adverse, okay, B is adverse, okay, but for this one is you're getting a favorable variance over here. So if I'm just totaling it up, I'll be getting 446 favorable for this particular in total. So this is how you cross check. Okay, so you can cross check the usage variance. You can calculate the usage variance and cross check. Okay, so usage variance would be this. What I'm looking in here. Okay, so this is usage variance only calculation. So 446 favorable again. So usage variance split 150 favorable and 296 favorable, which is coming as 446 favorable. So this is with this material variances. So for the material variances, again, just summarizing it up, we have a total material variance, which is the components of material price and usage variance. And if you are using more than one raw material for producing one unit of a particular product, then you will be having a material mix variance and a material yield variance in total. And we have just looked at how we are calculating this particular things over here. And that's it with it for today. And we'll be discussing with the other variances in the coming sessions. Okay, so if you have any queries, feel free to reach out to me. Okay, you can put a comment, and you can put a post at Instagram also at Snuma Tutor. And I'm available at YouTube, Facebook, and also on the Instagram chat or Facebook chat also. So do like and share this video if you find it useful. Okay, so thank you.